The type of debt that we're talking about here is called secured debt, meaning there is collateral tied to the debt. So if the debt is not paid, that collateral can be taken back. That's opposed to unsecured debt, things like credit card debt or, dental or all the other things that people, can also invest in, but there's no collateral attached. At Saint, we have zero interest in unsecured debt. We are secured debt investors, right? Primarily real estate. We want to be involved in real estate debt. First things first, let's start at the beginning. Today, we are going to cover, here's a quick overview of what we'll dive into and what we will be covering on today's mortgage investing masterclass. This is a personal favorite topic of mine for a number of reasons. One is we're at such an interesting time in the markets. We're just kind of talking about major sell-offs. We got Warren Buffett sitting on 135 billion in cash. We have the most C-level executives in history in the stock market selling off their stocks of the companies that they work at. We see huge market movement in very, let's say, concerning directions. So the biggest question we're getting from our most sophisticated, our most advanced, our smartest investors is where we are looking. I think commercial real estate is an amazing space overall, but I think commercial real estate has a lot to sort through on its own as a bulk asset class as well. So today, we wanted to kick off the mortgage investing masterclass, talk about some strategies, talk about a deep dive on the asset class and the strategies behind that. So this is the overview. We'll go through a short overview of the space itself so that you have the foundations of the business, so that you just understand kind of top to bottom broad scope. We'll go through acquisitions, things like what to understand, things like what to look for and why. Then, this is very special. We debated on whether we should be doing this or not because it's a pretty big inside baseball approach that we're taking with this. We're going to jump directly into an actual deep dive, a walkthrough of what underwriting looks like for mortgage investing, for large purchases, for loans, so that you know exactly what's going on and if it's the right purchase and the right price. Then we're going to look at asset management. Let's say you get all these assets. What do you do with them? How do you manage a portfolio at the same time? We'll wrap up with a little pros and cons, just kind of zoom back out and give you an overview. And then portfolio-wise, strategy-wise, how this works for you, how you can apply this in your portfolio, whether that means rolling up your sleeves and doing it yourself or some other options in the marketplace. But before we get too far, in case we haven't met, my name is Nic DeAngelo. I'm president of Saint Investment Group. I'm blessed that we get to provide a lot of thought leadership in investment. We get to provide thought leadership. Most of these are on economics. So if you haven't joined us before and you want to get updates of what's going on in the economy overall and investment strategies through that, these live webinars are a huge opportunity to do so. As the president of Saint, I'm proud to say that our investments have had some really great performance over the years. Our income fund, especially our flagship product, has over 500 mortgages in over 21 states, and we're always growing. Overall, our portfolio has over 206 million in assets under management, and we have some handsome returns. We pay 12 to 14.28% returns on the high end of our income fund. And we get to brag about that we've been on time every time for over a decade. We've never missed a distribution to our investors, and that has been for over a decade. And this is that, just visualized. Just a brag slide. I love this slide, though. I love this slide. This represents a ton of hard work, an amazing team, and a decade plus of us kicking butt in what we're doing. So why are we qualified to talk about it? Well, you heard a little bit about us, but if you wanted to hear what investors have to say, I encourage you guys to check out our Trustpilot, our Google reviews. Our website compiles a lot of cool reviews and you get to see some inside scoop there. But search around. BBB, you can check us out. We're accredited there. We've been Forbes contributors for, 5-7 years. And then as always, we give all this away for free. We don't sell any courses of any type. All this is given away for free. Our YouTube channel has tons of free information, just like this, walking through it all. And then our website has a resources section, saintinvestment.com/resources, where we dive deeply into tons of different topics. It's all compiled there. So I encourage you guys, check us out, check out our reviews, and then check out our free information. So this is why our investors love us. Why do our investors love us so much? All these good reviews out there. We pay great returns. Number one, we pay competitive returns in the markets that we're in today. We have monthly payments. So we pay every month instead of quarterly or annually, God forbid. We pay on time every time. I can't brag about that enough. And then we have amazing reporting that makes our investors sleep well at night. So we have a lot to cover, but I wanted to make sure you had information about us, about what we do and who we are. Quick overview of the structure. We'll start off with a legal disclaimer. We'll make our attorneys happy, make sure we cover what they want us to. We're going to jump then into the topic, mortgage investing masterclass, a deep dive on the industry and our strategies that we see as effective today. We'll wrap up with some housekeeping, and last but not least, Q&A. The Q&A portion of this, guys, is arguably the most valuable, with so much information back and forth, so much good discussion. I can brag on our investors all day long that we have such a great investment community, but the reality is the high level mindset, the large amount of highly strategic investors that we have make this Q&A section, this Q&A portion really great. It's all live. This is me. This is us. We're all having a conversation here together. So that end portion, I highly encourage you to check that out. Let's make our attorneys happy. The big takeaways here. This is not investment advice. This is for educational purposes only, meaning this is what we find, this is what we see, but all investments carry risk. Past performance does not ensure or guarantee future results of any kind. So we want to make sure we check those boxes. A couple notes here with this specific webinar. Markets change over time. What we're going through today is a snapshot of today's market, today's industry, and what we're seeing. So all these items are completely subject to change and will change over time. So we'll give you what we see today in the business. We'll give you what we see today in the industry, but you have to understand tomorrow, next week, next year, these will be different and be evolving over time. We always like to be improving our own processes. Throughout this, I'll mention a sleep well at night score or sleep well at night consideration here and there. That all that means is, does this improve your comfort or our comfort with how we view deals and how we view terms of deals along the way? And we've started doing something new in the last handful. Lu Feng, I think you won a book last time, right? I think you won a book, but we started doing something new. It's a book giveaway. There's a few reasons we do this. One of which is that we want to, we give you guys a great snapshot of things going on, whether it's the economy or investment strategies that we're seeing, and there's infinite information on this. So we try to give you guys the best resource to help internalize what we're going through and give the perspectives another way, as well as we want to give this to you with your engagement. So who do books go to? Books go to individuals, to people that are engaging with us along the way. This makes it fun for everybody. There's a lot of great minds. I'm staring at the attendee list, a ton of people. So I want to hear from you guys. There's 3 ways to do that. Comments in the chat. So if you have comments along the way, drop them in the chat. A lot of times we're going to be digging into some interesting numbers. We'll be digging into some interesting concepts. If you have a comment, drop it. We want to hear it, right? Number 2, questions in the chat. We talked about that briefly, but if I can answer on the fly, I will. Otherwise, we'll bump it to the end and we'll answer all questions in bulk. And then number 3, we started doing polls. We started doing polls throughout. What this does with the huge attendee list that we have here, it lets everybody answer questions and not only add their value of their perspective, but see other people's perspectives. So you'll see the results of the polls once you vote, and then we can address those on the fly. It's really interesting and it's really powerful. Also, we Exactly. We talked about Q&A and we will. So yeah, we don't give away a set amount of books. The book giveaway is just for however many people are doing amazing. And we want to, we usually give away a handful. So engage and we'll get you a book here. Let's jump in a little bit, huh? So first things first, why mortgage investing? Let's start with kind of an overview and set the stage for why investing and why now. In the current market, in the market conditions that we're seeing today, there is a serious concern around the historic, major, rock solid asset classes. Simply put, stocks have had a record number of sell-offs by high-level executives, C-level executives. We talked about that. Currently, the top 10% of stocks represent over 75% of the market value. This is the highest concentration that we've seen in history, in the history of the stock market, okay? Commercial real estate, my love, right? I'm in the commercial real estate market every day, but there's a lot of adjustment, especially with the large rate increases, okay? We have massive inflation going along with rate increases. We have massive inflation concerns. We have massive debt concerns. We have a political element to this also. I don't care if you're on the left or the right. We're not covering that today. Trump, I like a lot of things that he's doing. There's other things that I'm not as big of a fan on. But many of the biggest opportunities that Trump's leaning into are things like bringing manufacturing back to the United States. By the way, you know who the biggest fan of that is also Joe Biden. He did the same thing. So the left and the right are leaning into bringing construction, bringing manufacturing back to the United States. This is inherently inflationary. Tariffs, even though tariffs, we're actually seeing success there. We're seeing things like Apple bringing a $500 million investment to the United States over the next I think it was the next decade to build out manufacturing in the US, the investment into manufacturing in the US. The reality is that's inflationary. The reality is these tariffs are inflationary. So we are not out of the woods by any measure of what the market looks like today. What we've seen is that our smartest investors have been asking us for fixed income opportunities with all of these things considered. What we have heard consistently is that they want stable, they want consistent, and they want conservative assets that are paying those returns, that are backing up those returns. So what we did is dive into the markets, review markets top to bottom throughout real estate, looking for the best asset class that we could find out of all those markets to meet the needs that not only our investors wanted, but the concerns that we had about the marketplace as well. So Saint's answer to the market situation we're in. Single family mortgage investing. Today, we are going to go through why that's the case in great detail, tons of detail. But before we get too far, let's start off with some highlights. 1, stocks likely have rough waters ahead. You see Goldman Sachs, okay, a little company called Goldman Sachs, predicting a slow decade ahead of stocks. Goldman Sachs is estimating a 3% average annual return for stocks over the next 10 years. Investor Business Daily, many other big publications are basically saying they recommend scaling back your stock holdings. Investor Business Daily, a large publication, they're saying they recommend a 20% exposure to stocks in your portfolio. 1 out of every $5 that you have invested, okay? So there's big questions like what to do with the other 80% of your portfolio. We've seen strong performance in the mortgage space, right? All of real estate, we've actually seen delinquencies of loans increase for all of real estate except for single family mortgages. Okay, so let's take, office, bloodbath right now. Even multifamily, even apartments have went up over 10x on their delinquency. This is concerning. These are big numbers that are concerning. In the meantime, single family mortgage delinquency just over the last year went from 2.1% down to 1.7%. So out of all of real estate, it's only single family mortgages where the delinquency rate has actually declined. Why is that? There's a handful of reasons, but one that we all know that's all over the news is what's called the locked in effect of the current single family home market, right? Over the last 5 years alone, mortgage payments, mortgage costs for borrowers have increased over 120%. That's just since 2020. Why? Because, well, one, rates have gone through the roof, right? We used to see threes. Now we're at north of 7, around 7 at any given point. So massive increase in interest costs, massive increase in interest rates. And then also property values have went crazy, right? So all that to be said, the net effect, if you go and buy a home today, is that same home is 120% more expensive for you on your payments than it was a handful of years ago. So what is the effect of that? What is the locked in effect on a data approach? If you look at Redfin's numbers, Redfin is quoting over 82% of mortgages today. Over 82% of mortgages today in the market are below 6% interest rates, okay? Which is interesting considering that over 50% of all mortgages throughout the US have an interest rate below 4%. This is near record lows for the history of the country. These borrowers, whether you're at 4% or 5% or 3%, you are extremely well insulated from the cost of living expenses, all that freaking inflation we're all dealing with along the way. And it gives stability because we're talking about 30-year investment instruments, 30-year mortgages, right? A few other interesting facts. Boomers, the baby boomer generation, the largest generation we've ever had in US history, owns about 40% of residential real estate. And the majority of baby boomers are saying that they plan to never sell in their entire life. So 10 to 20 years of basically baby boomers living the rest of their days in their current home. All that to be said, I got tons more facts. 20% of mortgages are government loan programs, roughly, with the US agencies guaranteeing those loans, et cetera, et cetera. The biggest takeaway here is that we have a rock solid industry in many different aspects, many different ways to look at it. And we have an interesting structure that's unique in the entire world in the United States. 98% of single family mortgages in the US are fixed rate mortgages. And the vast majority of those are 30-year mortgage terms. That is not how the rest of the world operates. To be clear, most of the world has much shorter terms of their mortgages, and many places have variable rates. That's the standard. We have a 30-year situation in the US where you have fixed rates the majority of the time. So that gives us an opportunity, us as active investors in the marketplace, gives us an opportunity to fill a major role with fixed income in today's investment space. Because leaning into this gives us unique opportunities to have huge foresight into what payments look like, into what returns look like, and expectations of cash flow look like with us as investors. So, what is mortgage investing? We've heard some facts of why it might be amazing. So what is it exactly? Simply put, it's being the bank in the homeowner transaction. So you take the role as the mortgage investor, as the bank, you are the lender, you own the mortgage that's attached to the property. How are we able to do that, right? Don't you have to be Chase Bank or JP Morgan or Wells Fargo? The simple answer is no. Okay, mortgage investing at its core is mortgage investing at its core is buying these mortgages. It's receiving the monthly payments, and it's stepping into that role as the bank in the transaction and working directly with the borrower. Most real estate transactions, there's a buyer, there's a seller, and there's a lender. The debt that's created in that transaction is an asset, just like the property is just like the property is an asset. Okay. So you can invest in the property, you can invest in equity investments, you can invest in opportunities with equity, but you can also invest on the debt side of transactions. To be clear, there are pros and cons to this. We'll go through all of them, or we'll go through many of them. And one of the biggest things to consider is the market timing, the market cycle of whether it's better to be a debt investor or whether it's better to be an equity investor. For the last 15-ish years, equity investing has gone gangbusters. We've seen so much upside. We've seen so many great returns by betting on the upside of equity. That seems like it's shifted quite a bit. By the way, we also had the lowest rates in history for an extended period of time in the last 15 years. I wonder if those go hand in hand to some degree. Now rates are higher. Expectations of rates, 10, 20 years out that look like we're about to be right in that 5 to 6% range by most projections. That sounds brutal to us that are used to low cost capital for the last 15 years. But the reality is that's a return to norm if you look at the last 100 plus years of real estate and of lending in the US. So what is a mortgage? Let's start drilling down layer by layer and kind of getting into the nuts and bolts here. What is a mortgage? Simply put, a mortgage is a document that ties the debt to the asset as collateral. Okay. So it's an agreement essentially between the borrower and the lender, AKA the homeowner and the bank, right? That lays out a loan to the homeowner along with using the house as collateral if the borrower doesn't repay. The type of debt that we're talking about here is called secured debt, meaning there is collateral tied to the debt. So if the debt is not paid, that collateral can be taken back. That's opposed to unsecured debt, things like credit card debt or, dental or all the other things that people, can also invest in, but there's no collateral attached. At Saint, we have zero interest in unsecured debt. We are secured debt investors, right? Primarily real estate. We want to be involved in real estate debt. So what is the basic structure of what mortgage investing looks like? How do we simplify this to understand it easily? What we do is work with banks. Those banks create the mortgages. We work with those banks to buy those mortgages from them in bulk. So we prefer to buy mortgages that are in categories of non-performing, right? You can see that kind of illustrated as the end goal here on the slide. Why? Is because we get a discount. In the most simple terms, if you buy performing mortgages, you're pretty much paying full price. If you buy non-performing mortgages, you can get a discount on market pricing. What does non-performing mean? It means that the homeowner is either not paying currently, or it might be semi-performing where they're making payments here or there, or it might be a rolling balance, or they might have something that, popped up previously where it's not a pristine, perfect performing loan. So we step in those positions, we buy those mortgages from the banks at a discount, and we work with the homeowners, the final step, we work with the homeowners to get them back on track and making their payments. Let's take a minute. Let's see the chat. Paige, it's never a bad idea. It's never a bad time to be the bank. The house always wins, right? If you're in Vegas, the house always wins. Bankers, the Banker's Code, the book that we're giving away, illustrates this so well. It's essentially like the same concept of Vegas. The banks seem to win because they've been doing it a long time. They know the industry. Lu Fong, great question. That's a longer answer. We'll dive into that in Q&A, but thank you for dropping that. That is a dang good question. We're going to cover that a little bit in this presentation also. So a win-win situation, that's the goal. That's the goal here. That's actually at Saint what we prefer doing on the investment side for a lot of different reasons, but it just seems to make deals make more sense. Why is this a win-win? It benefits struggling homeowners, it benefits banks, and it benefits our investors. That is a true win-win-win in our book. So the biggest questions we get at that moment, or at this moment, right, where we start breaking this down, we get from investors are, why would a bank ever take a discount on mortgages that they own, that they've already lent the money out on? Why wouldn't they just foreclose themselves on a mortgage that's not working? Why doesn't the bank just contact the borrowers themselves, the homeowners, right? Why would homeowners work with us and not the banks? Wouldn't they be a little, concerned about that or have reservations? Let's go down those one by one. First off, banks, okay? Why is this a win-win for banks? The reserve requirements, the amount of compliance that banks have today is at a record level. Okay. They have to be dealing with the Federal Reserve. They have to be dealing with the comptroller of currencies. They have to balance their books with their bad loans. That means they can't lend out as much. They have to have reserves for all these situations. If you understand banking at the revenue level, there's a huge amount of money to be made just on the fees that they make from originating these mortgages, creating these mortgages, as well as the earliest payments that they receive from these mortgages. So if you look at, let's say, an amortization table, which breaks down the interest and principal payments throughout a loan's lifetime, the beginning is almost entirely interest. That's almost all gravy for the bank. So in a handful of years, if the borrower's not paying, the bank has made a great return already. So to not have to deal with the compliance headaches from the Fed, the comptroller, et cetera, many times it's a life-saving situation for them to be working with a buyer, whether it's Saint or another investment group or another investor, to sell those loans off and clean up their books. Homeowners. Why is this a win for homeowners? They get to stay in their homes. I love this piece. Home ownership in the United States. For middle-class families, if you look at the statistics on this, home ownership is most commonly the most valuable asset they will own in their lifetime, meaning it's one of the biggest net worth generators for middle-class families. Getting to keep them in their homes is a massive win, okay? Not only that, at Saint, we buy with conservative loan to value, meaning a big chunk of equity that's owned by the homeowner. They get to stay in their homes. They get to keep that equity. They get to keep the largest asset that they'll likely have in their lifetime for many of these families. They get to hedge against inflation. They get to keep oftentimes their historically low rate. And many families, like we saw earlier with the boomer statistic, want to pass their assets off to their kids. So they get all these investment benefits of owning the home, and they get to pass the asset off and just feel good about it overall. So most of the time, with the way that we choose mortgages to invest in and the way that we do our due diligence, they want to stay in the home. We're working together. It's collaborative. I really like that. That's a huge benefit here. And then last but not least, it benefits Saint. It benefits our investors. We get to pay above average returns. We get to beat a lot of other markets. We get to have consistency. Again, a 30-year product, a 30-year loan product that we invest in most commonly, a good cash flow situation, a good cash flow outlook. And we buy pretty conservatively. So we see on-time mortgage payments in our portfolio over 96.5% of the time. So I love all that. It's a huge benefit for us and our investors also. Not to be understated that this is also real estate backed. This is also real estate asset backed. Okay. So there are other ways to invest in fixed income. We all know the obvious ones, things like treasuries. Okay. But the thing with treasuries is, let's say you get 4-ish%, right? Let's say inflation's on the way up, which it is. We've seen in recent reports. So let's say you have 3% inflation and you have a 4% treasury that you just invested in. Your net return's 1%. So the volatility of the market today, most of our investors, 1% is not enough to make them sleep well at night. There's the sleep well at night score. So all that to be said is, where else can you get stable cash flow? I think this is a good opportunity with a win-win-win structure. So why homeowners are not performing. So why don't they just sell these properties, right? Let's say that they're underwater. Let's say they've missed payment, right? Examples include things like death, AKA somebody's passed away, that property goes to probate, there's siblings or cousins or whoever's inherited that going back and forth. We're going to take a pause. Let's see. Great questions. John, I see your question. Zandra, I see your question. We're going to answer both. We're going to be going through this. Okay. So these are actually built in because they're great questions, and and they're pretty common that we get. So we'll go through this. If they're not answered the way, or not clear to you, I'll jump into them in Q&A at the end also. So why are homeowners not performing? First thing is death. Somebody passed away. They're going back and forth. The siblings are working out who should be taking over the home. Do they want to keep the home? Who should be making payments, etc. It's a huge disruption. Somebody passed away. They're figuring out the estate of the deceased, right? Next is something like disease or health related issues. Maybe they have, some bills that have piled up. They had some kind of unforeseen circumstance that they are now dealing with where they have to make some tough financial decisions and kind of need some breathing room. Another is you'll see family, disruptions, things like divorce, personal issues at home. There was a big one called COVID that happened, right? Global pandemic. We'll add that to the list. What basically happened was a mandatory government shutdown. People had mass layoffs, or companies had mass layoffs. Small businesses failed in record numbers. There were furloughs all over the place. All of these add to inconsistencies, to disruptions of the market that cause people to not make their payment all the way and not be able to cover it. So why don't they sell their properties then in these situations, all these issues that are coming up? Well, we talked about it. They're locked in for the most part. So it's really hard to look at a property and look at evaluating a property of if they want to get rid of that, when the reality is if they bought the same property, it'd be over 120% more expensive in the market. So many see this as an opportunity to have wealth in a stabilized asset, and they don't want to lose that, right? Do they want a 7% rate when the current property might have a 3 or a 4? No, they don't want to over double their rate that they're dealing with, right? And then a 50% increase in homes since COVID, that's pretty brutal. Most people don't want to step into the market with that being the case. Kenneth, not only do I have an answer to that, I have a whole spreadsheet on that. I can't wait to show you. It's a really deep dive we do on the due diligence there. So I love this question. We get this regularly from our investors. Why don't I just do this myself? Why don't I just do this on my own? To be fair, we have great investors, and they usually ask this question with a little smile or a little tongue in cheek, right? A little curiosity behind it, because our investors are pretty smart, and they know that if they have the money and if they have the time and if they have the interest, they can do all kinds of things, right? But most don't want to do the work. And most don't want to build a business, and most don't want to manage the business behind it or spend the 5 to 7 to whatever amount of years to get there. So the good news is, why don't I just do this on my own? The good news is you can. There are no laws stopping you from doing this. With the things we're going through and what we'll continue to go through, you'll have a good start here to get the ball rolling if you wanted to do this. We don't sell a course. We have nothing to sell you along the way. The only thing we offer is to invest with us. I have a ton of money in our own fund. So if you didn't want to do it, you can invest with somebody in an amazing group, or you can go do it yourself. But I'm going to make a big but here. I will say one thing on this note. Please do not make up your mind until the end, because the amount that we're about to dive into of really the nitty gritty of this will truly give you an idea if this is for you and you want to be operating, or if you want to be getting, comparable returns and not be doing the rolling up the sleeves and doing the day-to-day on it. So while there's no laws, holding you back from doing this on your own, the reality is there are a ton of limitations. There's just not a law preventing a private investor from owning mortgages. Many states have different degrees of licensing. There's advanced compliance. There's tons of overlays. There's 50 states. There's a federal law, many local laws, etc. So I'll make the point here. Please check the laws of what states that you want to operate in. Please be compliant. If you're a cowboy or cowgirl at this stage, there are massive penalties for not doing things by the book. And these are things that could be even in the criminal category. So I'm telling you, please, if you do this on your own, I'm rooting for you. I want you guys to kick butt. We give all this information away for free for that reason, but please be compliant. Some considerations of going into this on your own or jumping into the space. The first is diversification, okay? Most commonly, early investors that really have an interest on doing this on their own, they ask the question, well, can I just buy one? Can I just buy one mortgage, right? I don't need to buy them all. I don't need to buy 100, but can I buy one mortgage? And the answer is yes, you sure can. You definitely can. The reality is there are a big chunk of mortgages that don't have amazing outcomes, especially when you're buying on a one-off situation. Why? Because if you have access to buy single individual mortgages then that means that mortgage has likely been passed down and looked over by so many investors and so many groups that typically buy bulk that the seller has to sell it as a one-off. Usually these are the worst of the worst, bottom of the barrel type investments. Not to say you can't do it, not to say it's not worth learning, if it checks the boxes that we'll go into on due diligence, but I would urge you to consider that not only is it a huge risk from a diversification standpoint, having all your eggs in one basket, it's also a risk that you're probably not going to get the returns that you would buying in bulk. Just the nature of investing. If you go bigger, you buy more, most often you get better pricing, you get higher returns for buying bigger chunks. So I would tell you that the history of the real estate market was doing it on your own. You used to have higher returns. Essentially across real estate, across all asset classes. We don't see that in really any asset classes at this point. If you buy an industrial building and you're buying it on market and you're buying it without the, tenant in tow, without understanding the local market and the dynamics and how to really squeeze value out of a property, you're probably not going to beat most funds. It's the same way with mortgage investing. So it's just an interesting note there. Also, there's the time and the money aspect, right? I cannot overstate how much this is a business. This isn't a passive investment strategy. I want to be clear on that. So if you really are passionate about loans, you're passionate about mortgages, and you want to really truly build an entire business from scratch, just keep in mind the vendor relationships you have to build, building out all the new systems, building out a team associated, foreclosure protocols, compliance, et cetera, just it's all one thing. It all comes along together. Most of our investors ask this question because really mostly they're curious. They want to kind of know our answer. And I think it's kind of a fun question to ask. And when I'm investing, I usually ask the same thing. Oh, last note, by the way, if you do want to do all this and you do want to do the legwork and you do want to do this lift, our fund is not going to be for you. It's a passive fund, but stick around. We still want to root people on and, do their, and support their journey as well. Benefits of mortgages. Okay. Why are mortgages great? We went through some market dynamics, but let's just talk about logistical dynamics with the asset class. We'll go through some things like the capital stack, why it's a little bit more secure to be on the debt side of the equation rather than the equity side. We'll talk about how debt investments on this spectrum will literally have a lower risk associated with them because they're less impacted by that. So we're going to take a look now at that. Capital structure, okay? The capital structure of just a general deal. This is also called the capital stack. You can see that as you go higher in the capital stack, your risk and your return often go up. The issue in today's market is many of these equity returns, whether you're talking equities like stocks or you're talking equities like investing in a syndication type approach. This has changed. Our income fund, where Saint invests today, we are in the debt side of the capital stack. We are working with senior debt. We're not opposed to junior debt as well, although it's less of our focus today, but we are on the debt side of the capital stack. We are debt investors. What we find is that today's market, the risk-adjusted returns, debt is crushing equity. We're even seeing capital calls and things on the syndication side. All right, so that's a good outlet. That's a good layout, of what a capital structure, a capital stack looks like so that you could take a look. Ooh, Lu Fong, love that comment. Let's talk bonds. Let's compare some bonds to returns that we see more so on the mortgage side. We chose this chart for a few reasons. One, it's a 15-year, 16-year period, really. And it is before the chaos of massive inflation. This is a few years old by design because it's a chunk of time that was pretty stable in the capital markets of the US and that we really saw things rebalance post 2008. These are the average returns for that period of time for fixed income assets. You have all the way from high yield bonds all the way down to T-bills, to treasury bonds. Private real estate credit delivered 12% in that period of time. Very good returns. That's also 3x what the lower end of the spectrum returned at that time. Okay, making sure we got caught up on comments. So this is a good illustration, guys. The purpose of this being here right now is to give you guys an idea of the fixed income world and how they size up with each other in normal, non-insane markets like we're dealing with right now, while seeing there's a varying degree of what these returns are attached to. So real estate, bonds, corporate bonds, investment grade bonds, treasury bonds. Sleep well at night score. I want to hammer this. I want to hammer this home. The two biggest things that we see as the driving factors behind sleeping well at night with your investment, number one is collateral. It makes the investment more secure. The borrower has a lot to lose. The borrower has things on the line, a literal physical four walls and a roof that they can lose if they don't perform. This is tangible. It's real. This isn't like dental debt where you're going to get calls and letters for the next 10 years, okay? Or 7 years. At the end of the day, it's real. They have something to lose, which means conversations can be productive. You can work well together to find a win-win solution, okay? The second is yield. Again, I talked about this briefly early on. I think there's yield hurdles, an industry term. I think there's a hurdle that investors need to consider for their yield. At some point, there's things that exist that are too low of yield in the marketplace. I believe that. I'm not a T-bill investor today. It's too low because the risk of having a 1% margin, my real net return of 1%, it's just cutting it too close with the volatility in the marketplace. So if your collateral's on point in your debt investing and your yield is good, considering the risk associated, I mean, we're talking about essentially the most conservative asset class in real estate, then you have a position where that sleep well at night score is likely a lot higher. Okay, let's roll up our sleeves. This is the beginning of a really deep dive, okay? I'm going to take a sip while you guys start thinking about acquisitions. We're going to start with the term buy box. What a buy box is the set of criteria and where you judge them and where you value them and where you want to be for that box that you buy within. Things outside of that buy box are no-nos, right? So the goal is not that you get in and you find all these good opportunities and you find out how to invest and, you know, somehow you work your way up with an amazing bank and have access to their assets. And then you look at their assets and you don't know what to buy because you don't know what's a no and you don't know what's a yes. Right now, we're going to go through the details of what the decision process is for each item. The first is loan position. Which order of priority the loan is on the collateral in order to collect, okay? Is it a first position loan or is it a second position loan, etc.? In the case of foreclosure, the senior debt, the first position loan is the most secure. Any loans on the home, any other junior loans on the home would be junior to that senior first position loan. Now, there are pros and cons to senior and junior loans. I do not want to poo-poo on seconds. I think there's great opportunities for seconds. We do buy them occasionally, although that's not really our focus today. We've bought them quite a bit in the past with great success and been very happy there. But that's a decision for your buy box along the way. Seniors are more secure. Senior loans are more secure. Paige, that's right. Municipal liens, etc. There are some situations where a senior position is trumped by a couple lien types, a municipal lien for sure. But generally speaking, for loan and for debt positions, senior first mortgage is senior. Let's see. So secured versus unsecured, AKA this is a discussion on collateral. We talked about this. Kenneth, that's a great question. If you buy a first, can the owner take out a second? The answer is yes. The answer is yes. We'll get into LTV strategies. We'll talk about that. Again, we got a lot of inside baseball here. And we'll talk about what we like better than looking at LTV, which is what's called CLTV. And we'll dive into that and I'll show you some illustrations of what that looks like, Kenneth. Okay, so secured versus unsecured. Basically, does it have collateral is the real question here. Think of credit card debt as the classic unsecured debt. You're going to get some nasty letters. They're going to bug the crap out of you. Your FICO score is going to take a hit, right? But you don't lose a physical thing. You're not losing your home, for instance, right? Secure means that there is a loan against a real asset. A true asset. Credit card debt, no loan, unsecured. Secured, loan against an asset, there's a home involved. Real estate is the classic example of a secured debt structure, okay? At Saint, we only target secured loans, okay? We only target secured loans. The security that goes along with having collateral is what we're looking for, number one. Number two, we are real estate. We go into real estate. We focus on real estate. We're not going into other areas of debt, only real estate debt, okay? Next consideration, loan size. How big is the loan on the property? Bigger loans require larger investments, obviously, but it also allows you to have to have less assets in the portfolio. So it's easier to manage, simply put. Bigger loans, less management. There's an advantage to that, but the flip side is smaller loans also make you more diversified. So if you go for bigger loans and you say, hey, I just want a handful of really big loans, you're less diversified, but your management headaches are a lot less. But on the flip side, if you have a ton of tiny mortgages or tiny loans, it's very expensive. There's tons of management involved, but you're very diversified. We find at Saint, we want to be in the middle. Average loan sizes, average homes, average home values. We're looking for middle-class homes with middle-class size mortgages, with middle-class structures and situations. We like being right in the middle. So LTV, loan to value. This is one item that everybody focuses on. It's very important. There's a great reason for that, right? Rightfully so. LTV is the exact percentage is what percentage of a loan compared to the percentage of the total value of the property. So if there's a $100,000 property and there's a $55,000 loan on that property, the loan to value would be 55%. Okay. Kenneth, I'm going to get to your question right now on this. You ready? Let's make this a little more complicated on LTV. Now, let's say you buy that first position mortgage and it's $55,000. So you buy a 55 LTV. That's pretty conservative. But what happens if there's a second? What happens if there's a third? What happens if there's a fourth? What happens if the borrower goes out and gets 100 loans against that property, right? For that reason, we at Saint use a structure called CLTV. What this is combined loan to value, okay? So if you buy a first mortgage and it's a 60% LTV, and there's a second lien that is 40% LTV, that's a combined loan to value of 100%. That's a bad deal. You're very risky buying a deal like that, okay? But if you have, let's say, a combined loan to value of only 60%, that's more on the conservative side, okay? So yes, there is a way to structure that and do the due diligence ahead of time to make sure that you're not buying into a situation that is, over encumbered or too tight as far as the property value is concerned. Next is location. There's a lot to consider regarding location, not just for a market benefits or downside, but also for a compliance situation. There are 50 states in the United States, okay? That means there's 50 different mortgage laws on the books at a state level. There are more counties that have complications. There are cities and counties that have different processes for foreclosures and bankruptcies and all things along the way, okay? We invest in over 21 states today. We've definitely have our preferences for our buy box of what states we prefer and don't prefer to work in. Okay. So what I'll say is that I think I said this earlier. I think I, gave you guys a little inside look ahead of time. We are more concerned about the market, the local market, the specialized focus of that market and the market type than the exact state. Okay. We're looking for middle-class suburban markets. We don't do urban at Saint because there's a whole bunch of considerations regarding cities and, you start getting into things like condos. That's not what we want to be in. We like the white picket fence, 3-bedroom, 2-bath, middle-class home, middle-class family situation. That's our fairway. That's our nirvana. Okay. So the states that have those suburban markets are great. We also don't do rural. Okay. We don't buy farmland. We don't do one house on 27 acres or a ranch situation because they're There's too much to consider there. They're one-off properties. The property valuation is a little more dicey, where if we buy middle of the road in our suburban markets, we can tell more commonly and more easily what that value is with a lot more clarity and confidence. Okay. So those are the basics of establishing your own buy box when you're going into the market. Okay. Lu Fong, let me see what you got on your question. Does first position necessarily earliest to lend? Can you be a later lender but jump to first? There's subordination agreements and there's some structures, Lu Fong, that you can change how that whole structure is, but generally speaking, that's the exception to the rule and not the rule, to kind of answer that directly. And then Bruce, how about vacant land? Well, Bruce, I'll tell you what, there are amazing investors in that space. We are not one of them. Okay. We avoid vacant land dramatically because the risk associated with it is just more than we're willing to bear. It's a lot of considerations. It has no cash flow. It can't really be owner occupied, which is another important item for us, but we'll jump into that. So not for us. Vacant land, there's whole strategies that go into that, but it's not for us. We don't do that personally at Saint. Okay. So a couple, yeah, and Lu Fong, you're welcome. As always, good questions. Performing versus non-performing. This is a good delineation. This is a good point to make. This is one of the most important points to lean into as you learn about mortgages and understand if this is for you. In the mortgage industry, loans get traded all the time. That is a huge portion of this. It's called the secondaries market, the secondaries mortgage market, the secondaries debt market. You know, these are tens of thousands of loans in a single trade at times. I'll show you an example of one later. And because of that, they have to be structured in a way that's easy for banks to understand and in a way that's a little more cookie cutter. This is where performing versus non-performing comes in. Performing loans are traded rapidly throughout the market. There's huge trades happening ongoing. When banks have mortgages that are not paying or have issues along the way, they're often marked as non-performing. Okay, this is the classic non-performing setup. If a bank is doing high volume origination and they want to create as many mortgages as they can and squeeze out as much margin as they can, they want to get rid of these non-performing mortgages because it ties up money that they could otherwise be lending out for their performing side. So this is why we buy non-performing mortgages, to get them off the books for these banks, to work with them to get discounts, to cut our investors in so that they're getting good returns also. Now, the next piece is a big point I alluded to lightly, but I'm going to dive in. Owner occupied versus investor owned. So you have a house, 123 Main Street. Does the family that owns the home live in the house? Okay. Does the borrower on the loan live in the house? Or is it a second home by, someone who wants a vacation rental? Is it some ski house, in the mountains somewhere? Is it investor owned? Or does someone live there full-time as their primary residence? At Saint, we like owner occupied. Why? Simply put, owner occupied, you're having a real discussion. So let's say they're in default. Let's say they're non-performing. You're talking with the person that lives there, meaning their interest, more than likely, is to stay in the house. They don't want to disrupt their family life. They don't want to be freaking kicked out of their own home. They don't want a foreclosure of their primary residence. This is important. Whereas if you're foreclosing on the guy's, ski house in Lake Tahoe, maybe he's a little less interested in working it out. Maybe he has other priorities where that money would be better suited for him. It makes you not aligned. It makes you in conflict more, we found. So we look for owner occupied when we are looking at investments in our own buy box. Developments, right? Construction situations, or Bruce, you talked about vacant land. That's one. So something in a development, entitlement, building phase, or a completed project, a standing project. We buy completed standing projects, completed standing homes, because entitlements, land, mid-construction, et cetera, there's a lot of risk that goes along with that. Maybe they run out of money. right? Maybe there's no cash flow on it. Maybe there's no backup to sell that. Maybe the bottom of the market falls out on land in a local area. Maybe it's more rural, one of our least favorite things as far as investing goes, right? So for us, we want that middle class, we want that infill location, and we are looking for middle class suburban areas. Debt duration. How many years are remaining? How many payments are remaining? For us, we're looking at 20 plus years. We love that long-term debt. We love that long-term stability. We love buying at a discount, aka purchase price, for something that's paying for a long period of time. We know it, we know what our returns are on an extended period of time with higher likelihood. So there are short-term debt funds out there. There are short-term investment strategies out there. Many people, fix and flipper loans, hard money loans, all kinds of structures where they do 12-month, maybe 24-month debt if it's real long, right? That's not us. We are looking for mortgages, things that are long-term investments, things that we could plan out on a long period of time. Senior versus junior, we jumped into, right? We talked about already. First position mortgages are more secure, generally speaking. Second position or lower, we are looking at the combined LTV to make positive we're not getting ourselves in choppy waters with that. We also talked about LTV versus CLTV. LTV, again, just as a reminder, is a loan to value of one loan to the property. So it doesn't take into consideration the rest of the loans on the property. CLTV is a combined loan to value of all loans, all liens against the property. Okay, sleep well at night score. We're going to jump back in and apply this to what we're talking about. What our investors, what we see as their sleep well at night score items, okay? Long-term cash flow solutions, long-term returns. And because of that, for our buy box, when we think about acquisitions, we are not looking to maximize returns. That's a good trend. That's a good item I want to put forth at this stage so that you guys understand where our mindset is. We want healthy returns, to be very clear, right? We're typically looking around 18, maybe around the 20% mark for many total returns on an individual mortgage. That said, we could squeeze out a lot higher if we did other strategies that we're not willing to do because it increases the risk, okay? So long-term positive outlooks, and maybe if you were looking at a buy box, you'd want to squeeze out every penny. I'd say that the risk there is going to be a lot higher, and there's going to be a lot of considerations with market effects, but we'll see those in a second. The next question is what's called sourcing, okay? Sourcing. What sourcing means in the mortgage industry, in the secondaries mortgage market, the mortgage investment world. Sourcing is how you find your deals, how you source your acquisitions, okay? So you have your buy box, you have your acquisition strategy. How do you friggin' get them? How do you find them, right? This is one of the largest questions in the industry because most deals are crap. Simply put, most of them are bad transactions and bad opportunities. So to zoom out of sourcing and to figure out really looking at it top down, there are only two ways for you to get a mortgage, to invest in a mortgage. One is you originate them yourselves, meaning you create the mortgage, okay? You can do private loans, with your own agreements. You can, seller financing is one strategy of this. You can carry back loans against the property. There's all kinds of really creative ways that you can originate your own loans. We don't do any of those at Saint. That's not what we do. That's not our preference. But you can really go the traditional route of origination, which is start your own bank, start your own lender, and really run a whole business on that. The other way, number two, the second way that you can source mortgages is by buying existing loans, buying loans that have been created already in the secondary market. This means you can buy them directly from these companies that originate these mortgages, or you can buy them from banks. You can buy them from financial institutions. You can buy them from funds. You can buy them. There's all over the place. There's mortgages that back up a huge percentage, a huge portion of the American economy. Okay. If the loan is performing, like we said earlier, expect to pay a lot more. The non-performing note industry, the non-performing mortgage industry is much more niche. This is where major relationships really come into play, because you're dealing with layers of financial institutions, large banks. We've worked with some of the biggest banks, some really big names, all the way up to, the PNCs and Wells Fargo's, all the way down to regional banks, to help them clean up their books. I mean, I was just going through a deal over breakfast last week of a handful of deals from a local bank here. I'm in Southern California. We have the benefit of having a lot of regional banks that do a lot of lending. So let's say you've identified which route you want to go. How do you find these mortgages? Unlike property investing, where you could just go on CoStar or LoopNet or Crexi or any of these different places where you can find all these real estate opportunities, or even Redfin if you want to just go buy a house to invest in, right? Unlike property investing, loans are not easy to find online. It's not the same structure. There's not a set database. There's not an online portal. There have been many. I would encourage you to not do that. They're basically the worst of the worst of the worst opportunities compiled for you to lose money on is most common. So I don't encourage you to do that, although you might be able to find some that are out there right now. So it leaves investors or interested investors in an interesting position. You have to connect directly with the sellers of these mortgages that have these books of debt that they need to clean up. Okay. Like I said, we manage a lot of time with relationships to be in touch with them. On your side, the best bet is to figure out the best opportunities that you want to have in inroads with. If you have a cousin that works at XYZ local bank, that might be an opportunity to check it out. Again, you'd be probably buying a one-off or two. Again, there's a diversification risk that goes along with that. But let's say that you find a relationship, you find a good bank or good fund or good financial institution. What then? Now you're going to get what's called a tape, a mortgage tape. It's essentially a loan portfolio that's for sale. It's essentially a long Excel sheet of available mortgages. Okay. Once you get to that point, you're in luck. You're actually starting to be a player and making moves to get closer to what that looks like. And you know what? We actually have a benefit. We're going to be walking through one of these together shortly, a tape. It's a mortgage tape with over 100 mortgages on it. So we'll see. It's been scrubbed a little bit so we don't give out personal information, but we're going to see exactly what that looks like. So why is this industry so difficult to access the right people to get these mortgages? Well, in the wake of the 2008 crisis, what we ended up having happen is that banking regulations went through the roof. And rightfully so, because we had so many BS mortgages and so much lending going on to people that weren't showing income and had fake jobs and all this stuff that wasn't being verified, that really these banks were at risk of default. The big five banks in the United States really almost went under. So since the 2008 crisis, the biggest lenders and really all lenders in the banking industry, not only are they under massive scrutiny, but additionally, they are also having serious concerns about reputational risk. Let me give you an example. Let's say you're Wells Fargo, and let's say you send out a loan tape to somebody you don't really know. You don't know how they do business. You don't know what they do and how good they are at what they do. Let's say that person goes in and forecloses on everybody, breaks all the rules, etc. What's the headline? Unknown investor does a bad thing? Or is it Wells Fargo originated a bunch of loans and took advantage of borrowers? The risk of that last one, it coming back on Wells Fargo, the reputational risk is far too high. These big banks especially, but really all banks, the reputational and compliance risks are so high that what they end up doing is working with people that they know, that they trust, and people that they know are going to perform, okay? So I want you to keep that in mind. When you think about this from the perspective of the bank, the opportunity is how to meet their needs, the bank's needs, so that they can be incentivized to work with you, simply put. So let's recap. Let's say you find some good banks, you find some good financial institutions. It's about keeping in touch with them, demonstrating that you're a good buying partner, writing big checks. I cannot stress how much money talks. If you let them know, hey, I can buy X amount of million, I can buy 10 million a quarter, you have somebody's attention, right? If you can even get to the person. If you get to the person, you have somebody's attention. They know that you're a great opportunity potentially to be buying consistently. If you say I'm a one-off buyer and I have this and I compiled the money from 18 cousins and we're only going to buy from you once, they're probably like, not that interesting because they're going to have things that they need to sell regularly. So we buy them directly. We work with these financial institutions. Some transactions we're involved with are north of 100 million. They're not only us. So what we do to tackle these massive transactions at Saint, we work with partners occasionally on the purchase side. We do what's called carbs. We do what's called splitting the loans up, where they take a portion, we take a portion, and then we can buy bigger loans together. We know that they're trusted partners. We know that they're people that we can invest with and buy better things and have opportunities for more because we both trust each other. We're all in the industry together and have relationships and reputations together. So that's a little bit about sourcing. There's a ton more we can dive into. We can happy to jump into the Q&A on that side as well. But I'm really anxious and excited to get into this next portion here. We are going to do a walkthrough of a tape. So remember when I said, hey, you're going to get, once you hit gold a little bit, you start working with the bank, they're going to send you a huge list of mortgages. What do you do then? Okay. Let's see, here we go. Okay. Got to adjust this a little bit here, the screen. Well, guys, what we're looking at here, this is a decade plus of us putting together best practices into how we analyze mortgages. So let's say we get a tape over from the lender. This is how we structure it. Let's kick this off. The gray squares here are going to be the basic information. Also, by the way, this is scrubbed. There's a ton of sensitive information here that we have removed. Okay. We're not going to be showing social security numbers. None of these things like recent case numbers or names or anything are accurate. These have all been removed so that we are making positive that we are keeping the identities of these loans and borrowers on track. Okay. And we're not letting that information out. So let's walk through this. As you can see at the top, you're going to see section numbers. All right. The colored sections are colored, one, because we don't want to go insane when we're looking at thousands of lines of Excel. We need some colors just to break things up. But number two, and more importantly, is there an order of how we tackle the data? Okay. So you'll see that they're not in order in the spreadsheet. We split this up on purpose because often these are done once, verified, and then we move on to the next section. You'll see that at the end right here are going to be the most pertinent details along with bankruptcy data, which we check regularly so we don't get surprised. So we check this throughout the process, throughout the transaction, and throughout for us to be able to reference along the way. First things first, let's start with section one, and then I'll kind of go through some of the gray for you. The first thing you do when you get a tape in, when you get a list of loans from the lender, is you need to start with basic property data, okay? This is what we're looking for right out of the gates. We're going for title. We're going for current owner, borrower, first, last, lien, comments. What does all this mean? Okay. Title borrower match. Title borrower match. This is a deep dive on title. What you can find is that the borrower on the loan and the title holder, the loan or the owner of the property, might not match. In that situation, what you're dealing with is a whole series of questions, right? Drop downs, yes, no. You're dealing with a series of questions. Did they sell this property? Did they get cute and sell this property off and give an assumed mortgage? Oh, I'm going to give you an assumption of my mortgage, even though the lender didn't approve that. That happens, right? You can have it where they do an arm's length or they do a non-arm's length transaction, and they think that if they deed the property to their deceased relative, that it technically voids the loan. It does not. Let's start there. But also, people will try a million ways to be cute. In one way, this is basically a cuteness checker. How cute are they trying to get with this deal, right? How many issues are you going to have, if you want to think about it properly, how many issues are you going to have linking the loan, the mortgage, to the borrower and the current owner of the property? That's what this section is here. Basic property data. We've deleted all the last names, but you can see, this is what it looks like. Just a whole bunch of names going down the list so that you know which file you're working through. You have your collateral property address. We've removed the address. We've just kept kind of the city, state, etc. Property type. You can see that land one in there. So let's see. It was, who asked about land? Bruce. So you can see when we see land, Bruce, well, the first thing we're doing is we're pulling that off, right? We're not doing that. Yeah, Lu Feng, this is an amazing spreadsheet. Honestly, this is like, oh, this is level 1000 geek mode for us. This is really behind the scenes. And this is a decade plus of us putting this together, but this is a huge amount of juice here. Section 2, we're jumping into property value assessment. We run through three different sources to verify the value of a property. Remember how I said we like suburban markets, okay? That's one of the reasons, is because they're much simpler to verify the value of properties, because there's a whole bunch of freaking houses right next to the subject property. If we find that we are not confident, and maybe these three sources are all over the place, we move to this called BPO. This is broker price opinion. That means we call a broker, a third-party agent, and we get their formal opinion of the value of the property, right? Now, I'm going to spot check with you guys here. How many loans are on this tape? 106, okay? So, Nick, are you telling me that for each loan you do this 3 times and then maybe call an agent to verify the value of the property 106 times? That's not even as bad as it could be. What you're looking at here, let's see, I'm going to extend the screen a little bit. I'm going to extend the screen. Do you see this thing carve F down there? That means this is one subset of a larger batch of loans, okay? So you might have A, B, C, D, and E ahead of F, which means if you have 100 loans on F, you also have 100 loans on A, B, C, D, and E. There's 600 loans in here at least on this one deal. The due diligence here is massive. So that's section 2, just verifying that the price, the value of the property is what you think it is, because these lenders, if you're buying from them and you want to be a good borrower, your expectation is that they're going to give you all the data they have. They don't really have an incentive to try and screw you over, but they might have 100,000 or 10,000 or 50,000 mortgages in their portfolio. If you think every line of every spreadsheet is going to be accurate, I have bad news for you there, right? So verify everything, and you got to do it line by line. Section 3, credit report data. Okay. So these are things like, the reason I like this tape and I chose this tape, the reason I chose this spreadsheet is because it shows junior and senior loans that we are going through on this. This is a mixed bag. So it shows you what it would look like when you're going through juniors and seniors. When you're doing this, you're gonna need the details of the senior loan as well. So at the beginning of the tape, there's a servicer loan number. You also want to know what the servicer is on the junior or senior. You need to know both servicers so that you can refer to them as needed or get in touch with them if you need more information, okay? Senior balance, junior balance, it's just, we talked about combined LTV. You want to know the total value, the total LTV. You can't know that without doing the research on it. You need to verify. This isn't just a credit dive. This is a title dive as well. So a couple sources to get this information. Credit score. What's their FICO? Are these guys going to screw you over with a 150 credit score, or are they at 820 and they can't wait to pay you on time and they just need to receive your phone call? You'll get spot checks throughout this. You'll start to get a pulse of these deals. And then at the end, you have comments. When you have your team running due diligence, you have your team doing the underwriting of these, the comments, we hammer this to death, is because it's a quick look at what we're doing and why we're doing it. You got to have that. Loan position, extremely critical. Current senior, junior status. Some of these Mark sucked at due diligence. Mark couldn't find a bunch of these. That's not good. Mark's not with us anymore, but God bless Mark. That said, not reporting, that's a real situation. That means you got to go get in touch with the servicer and go figure out what the status of that. Rolling 30 means they're 30 days behind, but they were still making payments. So there's a lot of details here. Senior lien servicer, okay? So you see some examples of servicers that are in the marketplace. Loan details, is this an FHA? Is this a HELOC? Then you move on to section 4. You're making sure, again, you're verifying the loan status of any other loans along the way. And last but not least, you move over to bankruptcy. walking through this process here, you start with section 1, you go to section 2, 3, 4, 5. If one section doesn't check out enough and it's just not in line with your expectations, or it's just too far out of your buy box, at some point you put the pen down. At some point you have to, as a business manager or business, using business strategy here, you wake up and you say, if each one of these is going to take an hour, and there's 106 loans on this page, and there's 5 other pages in addition to this page, and it's a massive effort of underwriting with many people involved, at some point, if it's too far out of your buy box, you need to have the sunk cost written off and say, we're not putting in the extra X amount of 100 hours to do this, okay? So that's why we do things in a very specific order instead of just starting from left to right, because by the time you get to bankruptcy data, you've already done the majority of the lift. Section 5, you're in bankruptcy review. This gets messy, okay? You're now dealing with a federal situation. You're dealing with chapter 13, chapter 7, chapter 11. Sometimes you don't even have BK data. It makes things very complicated. So all that to be said, let's poke around on some notes. Let's see if there's anything that we can pull out of here that I can point out to you guys. Loan status. These are good examples. Non-performing, we talked about. Carried balance. That means, let's say that let's say it's COVID, and let's say the family's there, and one of the parents lost their job and they're furloughed, and then the other one got a job, but it's lower paying than they used to have, and they're just in a tough situation, but they're still making their payments. They might have missed 6 months of payments during the COVID world, right? But they're still making payments today. That means they're carrying a balance with them. Reperforming, that means that there's a loan mod typically in place. They're now performing and making payments, but they haven't entered like a 6 to 12 month window of on-time payments to prove that they're now are performing or reperforming mortgage to a high degree. John, good question. So John asked, this is a great question, do you ever contact the senior lender to buy their portion of the loan too, thereby holding all the debt? So we primarily are the senior lender. We lean into that more. But in the case that you're dealing with a junior loan situation, a junior loan scenario, you do have that option. And not only do you have the option to contact the senior, which they're happy to talk to you, right? Because you both are in the same deal together. Not only that, but let's say that the senior is not performing. Let's say that homeowner isn't paying you and you're the second lien holder and the senior's not performing. You actually have a right by law in most cases to reinstate on the first mortgage, okay? So you as a second, if you foreclose, and this is way inside baseball, I know this is too deep down the rabbit hole, but if you foreclose as the second lien position, you can take that property over and you take over as the payer of the mortgage, okay? So you actually have a number of rights with the senior lender if you're the junior lender, John. But good question. That's a great question. So you have not just the right that you said, you can make them an offer and they may sell it to you, but in addition, you have a number of rights by law to cover your check. Let's see, lingo check, yeah. Sorry, I'm throwing around a lot of lingo. I'm just trying to, I'm moving quick on it. So maybe I'm not explaining fully each piece of it. But, oh, here we go. Oh, no, you're asking, Lu Fong. Okay. If the borrower missed 6 months of payments, but is now paying monthly, but they're not fully caught up, this is non-performing. To be clear, this is a non-performing mortgage. It's typically in that same bucket. Reperforming means they're fully performing and they're on track with it, but it's not still considered, oftentimes is not considered a fully performing loan for a period of time. I hope that's clear. So as you can see, guys, zooming out again, this is a massive tape. This represents 106 mortgages just on one piece of the carve, right? It shows 21. There might be 21 carve. I mean, this is a very, very large trade. And the dates, the things associated with it, this is a common structure that we use for massive due diligence. So I'm going to transition back to the slide deck. If you have questions along the way, I urge you to ask in the Q&A, and you guys have been great asking. Okay, so we just wrapped up the live walkthrough of what of what a tape looks like, what due diligence at a very high level looks like. So let's keep rolling. Now we understand what the massive lift on due diligence looks like. Paige, you're right. That's another term. Subperforming is also a good way to describe that. So let's talk asset management. Let's say that you have decided on your buy box. Let's say you've gotten in touch with the lenders. Let's say you've bought all these mortgages. Let's say you went in it with underwriting. Let's say you nailed down your pricing and how much you're going to pay. Let's say you sorted out the bad loans. You put in an offer. It got accepted. You paid the money to the seller. Now you have all these freaking mortgages. You have 106 mortgages plus 106 mortgages on all those other pages. You might walk out with 500 mortgages if you did this successfully. Now what? What do you do with all these mortgages in your portfolio, right? The first thing you got to do is you got to set up your service providers that go into this, right? That means your title work, your title research, having ongoing alerts and checking in if there's any title changes. You don't want any switcheroos on your watch. You want to have something called drive-bys where they're driving by and verifying that the house is still standing once in a while. You want to verify that they have homeowners insurance, etc. There are a huge amount of service providers, a huge amount of vendors that you can use. But I urge you in that position to be making sure they're in place. The next is loan servicing. So on the previous, when we jumped into the due diligence, we jumped into that spreadsheet. You saw a whole bunch of servicers. You saw a whole bunch of loan servicers, right? A loan servicer is a company that receives the payments on your behalf. They communicate with the borrowers in a compliant way, and they really help manage the bulk of the back and forth of a lot of these files, a lot of these loans, okay? They are more or less the equivalent of a property manager in the real estate space. They handle a big chunk of a lot of the forward-facing pieces. This is often the first vendor and the most important vendor you'll decide on along the way. So it is one of the most important without a question. As your portfolio grows and your monthly collections and monthly receivables and all that goes up, managing that is exhaustive and massive and extremely complicated. I don't want to understate that. I don't want to undersell that. So servicers they are worth their weight in gold, especially the more that a company scales up and owns more mortgages. Next, you're dealing with legal. First off, compliance. We talked about over and over about how crazy compliance is in the space, both for banks and lenders and investors, etc. And then the other half of legal is foreclosures. Foreclosures are real in this space. Again, guys, we're talking about non-performing mortgages. People are not making their payments or are underperforming on their payments. So foreclosures are a very big piece of this. Now, I'm proud to say that we minimize foreclosures quite a bit. That's not really our model at Saint, but we still are in the foreclosure process regularly and deal with it all the time, okay? So make positive that you're covering yourself, you're using good legal, you're making positive that you have great protections and compliance in the state that you're operating in. That cannot be overstated. And then there's protections along the way, right? Mandatory insurance. Your homeowners have to have homeowner insurance. If there's anything we've learned from the fires in Hawaii and then the fires in Los Angeles and the fires in all kinds of different things across the country, homeowners insurance, if you're a lender, homeowners insurance is mandatory. Your borrowers have to have homeowners insurance. If they don't, you have some protections in place, things like forced place insurance, where you get the insurance for them and they end up getting billed back for that in the meantime. Okay. So, exit options. Let's talk about ways that you get paid as the lender. This is an important point. You guys can take this and give me a second. Okay. Exit options. Here's the note. Nothing lasts forever. Okay. We are talking today about mortgages. And I already told you guys earlier, so I want to hammer this point that we're looking usually at Saint, we're looking at mortgages with over 20 years left of payments. So the likelihood of zero changes in that period of time is extremely rare. It's extremely low. So right now we're going to walk through the different exit scenarios that we see, how a lender gets paid and how our lender is covered in each scenario. One thing to point out here, one reason we are clearly giving away the book at the beginning of this of this presentation, of this masterclass, is because it really illustrates how the house always wins. I said that earlier, but this is where this comes full circle. The exit options, if you buy conservatively, you have a good buy box, and you really identify the most important traits to you, and you're conservative here, every one of these exit options is a win. Seriously, the vast majority of the time. So these are the most common that we see, and these are the most common that we see in the market overall. Let's start with a refinance. We all know what this is, but let's just, identify it a little bit. This is where the borrower refinances their loan, okay? So as the homeowner, as the person that owns the property, they have the right to be able to shop the market for a better rate or terms that they like better, or even go out and get cash out on the asset, right? So when they refinance, when they do find some deal that they like better, the new lender that they have pays off the old debt. So if we are the lender and they go refinance, we receive a check from the new lender. They send us a check for the balance, the amount that's owed. So in situations where we're working out mortgages, and we'll go through that a little bit, in situations where we're working out a loan with the borrower to get them back on track, very commonly we raise their interest rate. Why? Because they haven't been performing. The risk is higher, right? So there's typically an increased interest rate as part of a non-performing process, as something where the risk goes up for the lender. They also typically have impacted FICO scores, their credit's gone down, etc. So we raise their interest rate very commonly. That's something that's very in line of our toolbox that we utilize. So when they go out to refinance, oftentimes they spend years paying us, bumping up their credit, improving their credit score. We're big fans of that. We're always rooting them on. They improve their credit score, and then they go out to the market and they find a better opportunity than our loan. Maybe they save 1% or 2%. This is great for us. We are rooting them on in this case because we get paid essentially in full for a loan up front that we paid a discount for. Okay? Do you see that win there? They're giving us all our money up front on this deal. The lender wins, right? So if they get a lower rate after they boost their credit score, that's a win for them as well. Another win-win scenario in the lending space, in the investment space of mortgages. So most commonly in this situation, we get a good return off a situation like a refinance. So the returns are solid in this case. We'll typically see a huge boost when that happens. For us particularly, we typically just reinvest those funds back into the fund. We try to buy more assets and grow the portfolio further. So that's kind of the full cash conversion cycle of a refinance or a refinance exit. We buy the mortgage, we get them back on track, they begin paying us, they boost their credit and their FICO, they find a better deal in the market years later, they cash us out, and then we reinvest back into our own fund. That's how a mortgage exit typically works for us. Option number 2, sell or selling off or selling parts of our portfolio, okay? If we've taken assets that are not performing and then we have made them perform, simply put, the value of those assets goes up, okay? So this is the idea of a fix and flip in the home space. You buy a house that has a bunch of problems, you fix it up and make it beautiful, and you sell it for more money. Simply put, you have added value and you get paid for it. It's the same. Again, we talked about how loans are assets. Loans are assets, similar to real estate. So in that case, we have taken a non-performing asset and made it performing, so the value has increased. So we can turn around and sell that now performing loan that's making payments and get a higher return on that. Just like we can go back to the market with the money that we make off that, with the returns that we generate from selling those reperforming assets off, and go buy more non-performing loans. I'll make it clear that this is a great way to create portfolio growth, without a doubt. And it's also a good way to boost our returns, to be clear. It's a great way to buffer our returns, to boost our returns, but it's a lot more market sensitive, because if you're constantly just going through that spin cycle in the market, then you are dealing with the highs and lows of the market and kind of reducing the fact that the point of investing in mortgages, in my opinion, is to have access to 20 plus years of payments. That's a cash flow strategy. That is not an equity or a return focused strategy. So when I say we are not looking for every dollar in the deal. We are actually looking for more consistency long-term. This is really what I'm talking about. Many people in the mortgage space, they just are doing this spin cycle of deal, 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 deal. Sometimes they get caught and it doesn't work out as well. We are looking for the long-term strategy. What I'll say when we do utilize the sell strategy and when we start selling off portions of the portfolio, this is usually a reposition of the portfolio situation. If you looked at the last tape that we went through, the last portfolio that we just went through, you'll see that we saw a lot of, man, I didn't get to point it out this time, but you saw about 10 states on that tape, right, that we were going through. A huge portion of those were in Pennsylvania, right? I think Pennsylvania has great opportunities for investment, but let's say it didn't. Let's say I didn't like Pennsylvania and that we had all these mortgages from Pennsylvania. This is a good opportunity to sell those loans off, maybe a market that we have too many deals in that we prefer, and we get that cash back out and we could deploy that towards non-performing loans in markets that we do like, maybe better than Pennsylvania. So we look at selling really as more of a strategic shift in the portfolio and much less to generate and much less than to generate every dollar we could. We're looking long-term. We don't want a fix and flip model of mortgage investing. We're looking for the cash flow side. That's why we have an income fund, is to avoid that ongoing turn and burn. The next item is payoff. This is when the borrower makes all their payments, right? This is when they pay the mortgage off. Again, we're usually looking at 20 plus years payments. So this is a lot more rare for us. But let's say that we do have some loans that are thrown in there that maybe are shorter term debt terms or are, 5-year terms remaining or something like that. We root for them. That means that the borrower faithfully made every payment that they were obligated to make. This is the 101 by the book scenario. I mean, it is more rare, right? It's less rare these days when you're buying long-term debt that they make the full payments, but it's great. And the trade-off here is that on our side, the reality is we don't see it as long because people are refinancing more or going other directions with that. So, frankly, in this scenario, the best practice is just send them a freaking wine and cheese basket, okay? Because it's really nice to congratulate someone to have a free and clear home. That feels good, and it's more rare in the real estate market than you'd think. So foreclosure, the last item. I love talking. I wanted to leave this to last to kind of build some tension, right? Some foreclosure tension. This is what everyone thinks is the worst case scenario. This is what, oh no, we're in foreclosure and it's legal and there's a whole, legal process, and is there a lawsuit and is there BK and are they stalling us out? Long story short, what foreclosure is at its core is the borrower is either completely not communicating, they're not making their payments, they're not performing, they're paying when they want to, they're missing payments. And none of this is uncommon early on because they don't really know what to think of you as the new lender that just bought the mortgage. But this is when it's ongoing and they actually don't typically want to work this out. Okay. We're very comfortable here. My background, particularly, I'll talk about me. My background at the beginning of my career buying distressed assets, I bought foreclosures full time. I was on the courthouse steps. I bought foreclosure sales. So the ins and outs of foreclosure, it's like home. I mean, I was doing this when I was 21, right? I feel very comfortable with this, although it freaks most people out in the space. In the case of foreclosure where we're at today, our goal, our number one initial goal of everything is to communicate with the borrower. It's to get in touch with the borrower, because from there we can work everything else out. We know where they're at. We can kind of gauge them and we can really get the ball moving. So in this case, when we're trying to get in touch with the borrower, honestly, if they're not responsive, we're filing foreclosure. That's what kicks this into gear. Why? Because it becomes real. So let's say we're reaching out, we're trying to get in touch, we're trying to be, in communication with them. If they're not responding, we're filing foreclosure immediately. Not with the goal of completing the foreclosure, but with the goal of we're not wasting time, because we're not going to spend 6 months dinking around with letters and calls and they just don't respond. At some point, we're kicking it into gear and it's their responsibility to get back to us if we're making all this outreach. Once that's the case, we find out one of two things. If they respond, which they usually do, when they respond, more than likely, when they respond, there's sometimes we'll find out they're just done. They're just freaking done with the house. They're done with the asset. They don't want any more payments. They want to move on with their life. They want to move somewhere else. They don't want any concerns or risk or anything overhead. A lot of times they don't even want to go back to work in this scenario. Okay. So if we get in touch with them, foreclosure's filed, and we're in this situation, we have solutions for this. The number one solution in this case is what's called a deed in lieu of foreclosure. It's a document that this is giving the property back to the bank, giving the keys back to the bank. Okay. This is them saying, I'm done. We don't want to deal with this. Just take the house back. Okay. They can move on with their lives. They don't have to have a foreclosure on their record in the same way. And it just cuts the deal short and makes it simple for everybody. Okay. That's one option. We don't see that as much. But let's say that happens. In the case of a deed in lieu for foreclosure, like I said earlier, we're typically targeting at Saint somewhere between about 55 to 60% combined loan to value. So God forbid there's a foreclosure, our least favorite outcome, or even a deed in lieu. In that case, we are recouping that 40% equity right there. Okay. So if we go through a foreclosure process, we are taking control of that 40% equity. We are essentially getting access to a property for 40% below market. While this sounds juicy, again, I'll tell you, this is not what we want. Why? Because we're not in the business of selling houses. We don't want the property back. We are investing in mortgages, and getting a house back is not what we're trying to achieve. So let's say they're not nice. Let's say they're not good players and they're not playing nice, and they actually just telling us to shove it, and they don't want to work with us on the foreclosure side, and they don't want to work a deal out. And even if we, drop their payments and do all kinds of amazing things, they don't want to take advantage of it. That's when we have to actually go through the foreclosure process. If that's the case, we have something that we do a little bit differently at Saint to avoid this process. When that's the case, typically we'll move forward with this process and be diligent in getting in touch and trying to work with them. And if we just can't, we sell the mortgage off. Simply put, we sell the mortgage off. That is a high percentage play for us. Why? Because there are groups that buy mortgages that are moving to foreclosure as a specialty for them. That is their business model. Now let's say why. Let's figure out why. Let's say you're a fix and flipper, like we talked about earlier, right? Let's say you want a home that's discounted to market, and you get a bigger discount if you go through the foreclosure process that lasts, let's say, 30 days of the foreclosure. And let's say a company like Saint, for instance, went through the whole foreclosure process except for that last 30 days. You pay a premium for that. So at Saint, we don't want houses back, and we're not fix and flippers. So we go through that foreclosure process almost to the end. And if we still can't work it out with the borrower, we're selling that mortgage off to someone who specializes in foreclosures, that wants the property back and wants to go through that final stage. And we, at the end of the day, as an exit at Saint, we get paid a premium for that. Okay. So let's see. Let's check in with questions. Lu Fong, great question. Are foreclosure horror stories common? The house is trashed. I mean, I've heard them where they put concrete in the pipes, right? Horrible, difficult, like terrible scenarios. Lu Fong, to be clear, we don't really deal with those that much, to be honest. We don't deal with foreclosures much at all. We try to avoid them really at all costs, right? So we stay away from those heavily. We sell those off before they get there. Although I'm sure my friends in the fix and flip space have more horror stories than I do. So we don't have those experiences, one, and then two, we stay away from foreclosures as much as possible. Bruce asked, if you have a 96.5% performing mortgages on the ones that you buy, what percent do you file foreclosure on? Okay, so there's kind of two sub questions there, two sub answers, Bruce. 96.5% are performing on-time payments of our performing mortgages. So I just want to clarify that metric. It's actually 96.7, just to be clear, but we just say 96.5 because it fluctuates, and recently it was 96.7. What percent do we file foreclosure on of new non-performing mortgages? I'd say the majority, truthfully, Bruce, because we want to kick that into gear and start the conversation off. Many of these lenders, that we buy these mortgages from, many of them are just kicking the can on these. So when the homeowner gets their 800th letter that's saying, oh, you better pay it or bad things are going to happen, they don't take it seriously. So to answer your question, Bruce, we usually kick foreclosure in pretty quickly if we don't get a hold of them pretty quickly, not with the intention to foreclose, but so that we're all having an adult conversation about the seriousness of what is on the table for those homes. So I'd say well over half, Bruce, just to answer your question directly. If the property is owner occupied and treat the property right more than often or not, do you get the property in decent shape? That still needs to work, nothing too bad. Yeah, so Sri, it looks like you might have some experience there on that side. So Sri said that, in his experience and their experience, they get the property back in decent shape in a foreclosure scenario. And then yes, Lou, concrete in the pipes would be a nightmare. And I have heard those. We haven't had that experience, thank God, but that would be a huge nightmare. Okay. So let's lock back in here. Investor experience management. Okay. This is a very important piece of this. I want to be clear. This masterclass is not about how to raise money. It's not how to manage investors. And it's really a massive discussion all in its own right. So we're not going to dive too deep here. We're just going to stay at a high level. But when you do have investors and you are working with investors, here's a few ways to make their lives a lot easier and make them sleep better at night, kind of the sleep score that we talked about earlier. First off is what's called a fund administrator, okay? They manage a huge amount of the compliance. They provide third-party validation of returns, and they manage distributions to investors. So it's a third party that investors get to make sure are verifying and double checking a lot of the returns, compliance, and making sure that they are getting paid. Okay. So that is a big tool. To be clear, fund administrator is not mandatory. It's not by law. We've used one almost from the beginning at Saint because we found that our investors were so much more comfortable just knowing that a third party was involved, verifying returns and verifying how much money that they're getting paid and that it's accurate. The second is investor portals. Okay. This is extremely important. Give investors access to their financial and then to their investments at their leisure. That's the idea, is that at the end of the day, we want our investors to be able to check on their investments when they want to. Okay. Most investors are very busy. We highly encourage you to use a great portal so that they can log in anytime that they want, check on their investment, their returns, the payments they've received, etc. Okay. The more transparency that you can provide, the more confidence your investors will have with you. Reporting, it's the same concept. The more transparency you can provide and the more top down and top up approach that bottom up and top down approach that you can give on their financials, the more they're going to feel comfortable with it. We literally moved to monthly reporting at Saint. So that's been a huge success. Every month our investors get to see how much they received, how much they've received over the lifetime of their investment, and how much money they have invested with us. So in your reporting, I highly encourage you to just make it real simple and real clear for your investors along the way, because they will thank you and feel so much more comfortable. Honestly, this chart it just was too good to not include. Just that's the reason that's in here. What you're seeing is dry powder versus unrealized value. This is basically a breakdown of non-bank lenders in the banking industry. You're seeing an opportunity for private real estate debt investing, the rise of how big this opportunity is. And again, we chose years that were before all the chaos of COVID, just so you got a broad scope while still not getting bogged down in, the Federal Reserve printing, 36 trillion in debt and blah, blah, blah. So that was a quick spot check. All right, let's go into pros and cons. Here. Let's see. Oh man, Paige, you did get I'm so sorry to hear you got the concrete in the pipes. That's a rough one. That's like the worst example I could think of. And, but if anyone could get through that page, it'd be you. So pros of investing in private real estate funds. So debt investing, here's some pros. The first is relatively lower risk to equity investings due to the capital stack. Simply put, is that this capital stack the position in the capital stack protects the debt investor much more than the equity investor. We don't need to go through like a huge deep dive on these. This is more of an overview, but it's just giving you the pros. Low correlation to stocks and bonds. We talked about how brutal the stock market is and how many people are looking at huge concerns in that. So with that correlation, you want to be less correlated with the stock market. That also improves your diversification, the next one. And then there's just more stability in debt investing overall. Cons, this is just a fund con, right? It's liquidity. Typically funds have structures, right? They have structures of 6 months, 36 months, 6 years. There's all kinds of structures that go in that don't have immediate liquidity, like say the stock market, for instance, right? Barriers to entry. There's usually a larger amount of cash that's required to invest in private real estate funds, especially debt funds. Our minimum at Saint is 50 grand. So it's pretty reasonable. It's pretty reasonable on our side, but you also have to be accredited. So there's many people we get that are hugely interested in investing with us. And we have to explain that if they don't make over 200 grand or have a 1 million net worth, we actually cannot accept money from them. We can still give them all the information for free. We still have amazing fans and people that are big, supporters of Saint that we actually can't take their money. And we try to point them in whatever directions we can to make sure that they find success. But that's a barrier to entry. Not everybody can appeal or can apply. Not everybody can make that criteria, that accredited status. Risk, all investments have risk. Right? There's always a risk, especially, with real estate funds, there's a degree of risk that's associated with real estate. With stocks, there's risk that's associated with stocks. If you're investing in an AI startup, there's a risk associated with that as well. Scalability. I don't know if I fully agree with this, but generally speaking, it's not as scalable if you're dealing with a fund that really locks you in and that fund's in kind of a position where they don't want to be growing. And then valuation and reporting. If you're not getting good reporting, if you're not getting reporting on how much you're making on a regular basis, it's a pain in the butt. Okay. It really is. That's why we've went to monthly reporting on that side. So here's a good question. Let's check in here. Okay. So is the fund more at risk if the housing market crashes? Sorry, I'm organizing slides. I'm making sure we're structured there. Is the fund more at risk if the housing market crashes than real estate, banking, property, and other markets? Okay. Here's another way to look at this. The number one question we get is what's the biggest risk to the fund? And what they're actually asking, what most investors are actually asking here is what happens if the housing market crashes? Okay. That is a good question because that's the asset class we're backing up. We went through earlier how rock solid the single family housing market is for the next 10 to 20 years compared to other asset classes, even in real estate, especially against stocks, especially against others. The bigger question here is the housing market more at risk than say let's say housing drops 35, 40%. That would essentially be the biggest drop in history if that was nationwide. If you look at some of the worst markets in the wake of 2008 and you take the averages of those markets really in that post 2008 crisis period, you're looking at roughly a 35 to 39% budget decrease. And that is the worst hit that we've ever seen in history of the housing market. So I wanted to hit this on the nose and say that we literally at Saint underwrite to the worst case scenario we've ever seen in the entire country. Let me make the point that we had also financial institutions falling from the sky at that period of time. And we also now today in the housing market that's backed up by the regulations that have been in place since 2008, we essentially have the most structured, the most strict, and the most foundationally safer market that we've seen, potentially in 100 years plus for properties. In the wake of 2008, the loan programs and the scrutiny that banks are under have gone through the roof. So I want to say that my concerns over a housing market crash, I would be much more concerned at basically every other asset class before single family housing. I mean, even banking at that point. I mean, you're talking a financial collapse would probably be coinciding with any of these discussions. So we kind of addressed that. We talked about this. We target loans 20 plus years remaining on the payments. I think that's an important idea. So the term of the fund, this is one. So we talked about the length of funds and the length of the opportunity. At Saint, we structure our funds very flexibly. So you have an opportunity to invest with a minimum holding period of 6 months all the way up to a minimum holding period of 36 months with returns that scale all the way up to that 12 to 14.28% window. So 12 to 14.28%, very competitive on the upper end. And then also we return capital in 90 days after the initial period, the initial lockup period. So to kind of zoom back out, what are some takeaways as we wrap this up and we move towards the end here and we get into Q&A in a second, which I'm really excited about. As an investor, one of your primary objectives, especially in today's market, is to optimize your investments. It's to take advantage of opportunities that you have in the current market while avoiding the most extreme risks, okay? In this market, that looks like diversification. In this market, that likely looks like hedging against things like the stock market or things like other asset classes that are going through huge corrections. So we encourage you to be evaluating your asset allocation to ensure that you're meeting those diversification goals along the way. Also, we talked about how we would talk about some investment opportunities. I can't recommend our fund enough. You guys just saw behind the curtain exactly what we do at Saint day in and day out. Our processes, you see exactly how we make decisions, our mindset. So if you're interested and you want to learn more, Ange, can you drop the calendar link in the chat now? Or Luke, one of you guys could drop it in the chat now. You can book a call. Thank you, Jazz. Appreciate it. You guys can book a call, learn more about what we do. If you want to, I mean, you got a look behind the curtain. You really got to see what is going on the Saint side, what we're, what our portfolio looks like, what our management looks like, how we evaluate and underwrite deals. This is a top to bottom that you guys got to see. So if you're looking for an income fund, we are a great opportunity and be happy to show you more. The last thing I'll leave you with, because we get this question regularly. If rates go up and rates go down, what happens to the mortgage investing space? So if rates go up and we hold a portfolio of mortgages that are below average rates in the market today, that actually means that mortgages are more stable. That means there's less refinances. That means they want to stay and hold where they're at today. That means cash flow is more stabilized. And then on the flip side, if rates go down, it stimulates buying. That means prices of properties go up. That's good for us. That means that we will see more refinances and have more opportunities to be reinvesting in the market. So all that to be said, our income fund is growing amazing. We have a ton of new investors every week. We'd be happy to show you an inside look, to dive into the numbers, to dive into the breakdown, to dive into our strategies, to show you our investment deck that goes through layer by layer of that. But guys, you saw basically an inside look of exactly what we're doing and how we're doing it. If you're interested and you want more information, you can text wealth to the number on your screen, 949-787-0957. And you can also just screenshot or take a shot of that QR code, or you can hit that calendar link with to directly book a call with Luke to answer any questions you might have and to go through a customized investment strategy call with him.